Good afternoon and good morning, everyone. Welcome to today's webinar on leveraged life insurance. My name is Michael Mandarino. I'm going to be the host for today. I've been a life insurance agent for over 25 years now. I love what I do. This particular webinar we're going to be talking about is for the ultra high net worth, $10 million of assets or higher, talking about the leveraged life. So my partner Colin Steinberg is actually on a plane right now. He had a flight got canceled yesterday, seeing a client in New York. But Joe, you want to introduce yourself?
Yeah, thanks, Michael. Yeah, as referenced, I work with Colin Steinberg and Michael. I've been in the life insurance space for over 10 years now, 6 to 7 of which specifically in the leveraged life space or premium finance space, mainly on the design and servicing of these plans.
Thanks, Joe. We're so glad you're able to fill in for us today and fill in for Colin.
No problem at all.
Again, my name is Michael Mandarino. I've been in the industry for over 25 years. I'm a West Point graduate, Army veteran as well. Spent some time overseas, and we're really looking forward to having everyone join us on this call today. When it comes to premium finance, we've teamed with the number one premium financing company out there, which is Selector. You can see they've been around for over 85 years. They have over $11 billion of death benefits and over $1 billion of cash value in place. So premium financing is just, it's not your normal life insurance policy. It takes an entire team. So the team that backs us up, we have CPAs, we have lawyers, there's potentially trusts involved. So today's webinar, our main goal is to kind of teach you a high level, but most importantly, we want to sit down with everyone personally and offer you a free opportunity to look at how does premium finance meet your potential goals for either building wealth or building a legacy for your family. And if you're not quite at that $10 million levels, please set up a call still with us soon because we can help you get there in different ways. And we also have other strategies that aren't only just for the ultra high net worth. So a little housekeeping. Our information is in the chat. So please feel free to use the chat function that goes to myself and Joel. Also, there is a Q&A. We're going to be holding all the questions and answers at the end, whether you type it in, and then we'll also, if you want to come off on microphone later at the end, we'll be able to give you that same opportunity. So again, the key factor with premium finance is finding a team that works with you. There is so much detail that goes into these policies. And more importantly, there's so much planning that goes in after the policies. So without further ado, we're going to get into the webinar. So for those that don't know about life insurance, the main reason we're talking about is the tax advantages that happen with life insurance. So most people know that the life insurance, it does come with after-tax dollars. The policy is either owned or either by a trust or personally. So when we work with our attorneys and we're looking at estate planning, you may hear us talk on this slideshow about irrevocable life insurance trusts or ILITs. Those are things that we can help create for you based off of your unique situation. The other interesting part about the life insurance is cash. The value grows tax deferred. In some states, like here in Florida, life insurance is also a protected asset. So you can't be sued for it. Not every state is like that. Obviously, for those that are here in Florida. But really, the other thing you're going to learn today is how we're using leverage inside these policies. With life insurance, you can actually borrow from your policy, and that's what we're going to be talking about, having some tax-free withdrawals. And in most cases, the life insurance death benefits do become tax-free to the estate. If there is an irrevocable life insurance estate, we're going to actually include that outside of the estate. And again, we don't expect you to remember everything. Just know that when you work with us, you're going to be working with Colin, myself, Joel, and the entire team at Selector. We're going to be bringing attorneys on the phone. We can work directly with your CPA and attorneys if you already have an attorney that's going to be creating your trust and so forth. So big thing is after tax, deferred growth, tax-free distributions, and a tax-free death benefit. So those are the main advantages we're going to be talking about today with the life insurance. So why leverage life? It's a proven strategy. It's been around for over 2 decades, almost 2 decades. And I'm sure everyone on this call has bought something on leverage, whether it's your house, whether it's a rental property. You use other people's money to purchase large things. So we found in the industry that not only with life insurance, because of the rates are larger inside the insurance policy than it is to borrow, that's the secret behind leveraged life insurance. It does give us that flexibility of being able to borrow other people's money, in this case, banks. And we're going to talk about why banks love this as a strategy. The big thing is that asset is going to outperform the borrowing costs. That's what we talk about is arbitrage. Again, when we sit down with you on your unique case, we're going to build studies that we're going to build case studies. In fact, Joel's one of our guys that actually helps build these illustrations for us to really help meet your family's needs. So there's the interesting part we're going to be talking about today is indexed universal life insurance. So for those that don't know that, the big thing is there's no market volatility. Unlike real estate or stocks that go up and down, with index universal life, there's only positive years. There's never a negative year. You just don't earn interest in the negative years. So that's why banks love this as an asset class to be able to loan against. They love having this on their balance sheet because there's very, very low default risk. And there's 100% loan to value on cash policies. So some common use cases we're going to be going over today is estate planning, tax efficient wealth accumulation, being able to actually take income. And one of the favorite things we love doing is building a legacy, not only for yourself, but also for your generations to come. Similar to what some folks may know is like how the Rockefellers have kept their wealth over and over, generation upon generation. So again, we're going to be looking at the goal for today's meeting is to give you a high level. We'd love to have this conversation with you to help build it and structure what looks exactly for your family and to see how leveraged life potentially will fit into that. This is a basic premium financing structure. Again, this is very high level, but we have the client, we work with the bank. In this case, we're showing you having a trust. So what happens here is the trust actually borrows money from the bank. That insurance policy is used as a collateral assignment as a cash value. And the client or the trust in some cases pays the interest. Life insurance company gets involved. We pay the premiums there. They issue an insurance contract. And then ultimately we get to number 6, which are our beneficiaries and so forth. So when it comes to premium financing, this is very kind of high level. Every situation is important to sit down and whether we need the estate planning attorney on the first phone call or once we try to understand what you're trying to do. Again, there's so many different unique strategies and how to use this. When you sit down with Colin, Joel, and I and our team, we're going to help build that for you. For those that are just joining, the chat function there does have our information to be able to contact us afterwards and set up a personalized strategy meeting. So case studies. So again, these are going to be some high level, but these are some of the cases that we've worked with. So first one we're looking at is we have a couple that uses finances to maximize their retirement benefits. So in this case, we had a 50-year-old couple. Their goal was to have tax-free income at retirement. So by doing that, we used some leverage here. In this case, they had a $1.25 million capital commitment. Normally, the way we build these structures, that's over a 7 to 10 year period. In most cases, and you're going to see this later on, is the insurance company uses the bank's premium. So the bank actually loans the money. And then you have to have some skin in the game as the investor or as the trust. And normally you're paying at least the interest, if not more, every single year. But in this particular case, that 50-year-old couple, we were able to generate a 475, almost $500,000 of tax-free income throughout their life expectancy. And in addition to that, we're also able to leave money to the next generation. So again, this is one idea of depending on if you're in that particular situation. Well, what if you're not 50? What if you're 60? So in this particular case, we use it to fund an estate. So here we are able to typically, when you look at premium financing versus regular life insurance, in this case, we compared a $10 million funded life insurance policy into a whole life And that $10 million generated a $25 million whole life insurance death benefit policy. Now, what we were able to do is we were able to lower the upfront cost for that 60-year-old to only $1 million. But we were able to increase the projected death benefit to $44 million. Again, there's definitely growth that happened there. There's timing that happens there. These assumptions were based off of hypothetical performance. But again, these are going to be some things when we sit down with us and have your unique planning strategy. What does that look like? We're going to help figure out. Now, you may say, okay, I'm not a 6-year-old, and most likely I'm also not insurable. So we had an 80-year-old we sat down with that was not insurable, but still want to leave a lasting legacy wealth. So we were able to fund a leveraged life insurance strategy on his children within a trust. And that's really where the planning starts looking really interesting, where the children can start borrowing from the policy. And when you start learning about how the arbitrage works inside these policies, those loans can go on until death. And then there's always, in most cases, the way we do our planning. And that's going back to the real important thing is you want to make sure you have a team that builds these policies, and they're very strategic of how they're built. And we look at every single assumption that comes with that. But in this particular case, we're able to generate lifetime income for the next generation, which would be his children, passing the death benefit tax-free to his grandchildren, minimizing the drag on taxes. So that's really where the ultra wealthy are using life insurance as be able to skip generations, using irrevocable life insurance trust to actually have the money set outside the estate. Another example we had 2 partners that needed $50 million of coverage for their buy-sell agreement. Their initial approach was they wanted to be the most inexpensive way of doing it, which is, for those who don't know, term life insurance is the most inexpensive way to get life insurance. But 1% of those cases ever pay out. So 99% of the time, sometimes 98% of the time, depending on what poll you're looking at, do those policies ever pay out. So really, you're just renting that life insurance policy with term, and most likely you're going to outlive that term. So what we did is instead was we're able to have them pay roughly twice the amount that they're paying on their term, but we used leverage. We started using the banks involved. So now not only we created a permanent solution for them for that $50 million of coverage each, but we also were able to help them create an appreciated asset for their balance sheet, ultimately leaving an estate planning opportunity for their families and their legacies. So again, these are 4 major unique areas of how we kind of use this. If you don't fit this, give us a call. We want to personally see what else would fit for you. If you're younger, if you're older, and so forth. Every situation is different. Every one of our clients are different. And the biggest thing we're really trying to do is we're trying to offset where the estate taxes are going to be. I'm not a tax accountant, but currently right now there is a $30 million tax exemption. So these strategies are typically for that $10 to $20 million or higher net worth folks that by the time they pass away, they're going to be way over that $30 million tax exemption. And that's where life insurance plan becomes so important, because you don't want to give up upwards of half of your estate over $30 million to the state that you live in or to the federal government, to the IRS. So now this is going to be very, very high level, but this is just to let you know like what a 50-year-old preferred non-tobacco, non-finance life insurance policy would look like. And if you own life insurance, you may have something very similar. So what you're seeing here is that 50-year-old puts in $300,000 for 20 years. So that's what they call a 20 pay. So they're putting in a total of $6 million. From the very beginning, there's a death benefit of $20 million. So put in $300,000 and you get a $20 million death benefit. That $20 million does not grow. You can see that full time period. They can obviously borrow from this as well. There are some values of being able to borrow. In this particular case, we looked at it where it was just a guaranteed universal life policy where they weren't actually having any cash value. This is the most inexpensive way to just create a legacy that's guaranteed off of $6 million. But we're not here to talk about regular life insurance. We're here to talk about what does that look like to finance that same opportunity. So what we did here is that same 50-year-old, we're showing here in the column is this is money they're able to borrow And again, that $10 million is really the area where most banks are looking for. So looking for that individual that's worth 10 million or more. If you're below that, still work with us. We have other programs that do work with you where you are not using leverage life. But in this scenario, we're borrowing a total of $10 million. Now, here is the interesting part about how leveraging works. The $10 million is borrowed from the bank. You're out of pocket cash flow. Again, this is just a rough idea. It could be more or less of how we plan this. But in this case, we're only paying the interest of $125,000 a year. So the actual outflow for that individual here is 1.25 million. And what you can see here on that far right corner, 20 million, 19 million is where it's starting off. It starts growing to 20 million, keeps growing, growing, growing. Again, these are hypotheticals, but this is based off of how the indexed universal life strategy. So instead of having a $20 million death benefit and paying $6 million out of pocket like the whole life policy was, in this particular case, if they died at age 88, you're looking at a $45 million tax-free death benefit, and the loan is being paid back as well. So you can see here, just to highlight the key factor here, that death benefit grew to $81 million. There is a loan balance there. And then there's also cash value that's associated with this. So this particular policy, the way we build it is there's also actual extra collateral needs to be held outside the policy. So again, the reason why banks love this is 100% of their loan is going to be protected. So that's where that very low default risk is. So, they have the loan balance. So if death were to occur in the first year, 2 years, 3 years, 5 years, that death benefit is going to be paying back the loan balance. But in addition to the cash value, there's also a collateral projection that is needed. So, Joel, you want to come off and talk a little bit more about how that loan process works?
Yeah, sure. I'll also just highlight the overall flexibility of this. This is based on a 50-year-old looking at Penn Mutual specifically, sort of a standard 7-pay scenario. Depending on age, health, ultimate carrier that we go with, ultimate banking arrangements, it could only need a 5-pay, which would, be sort of less stress on the whole plan, or it might need 10 years of premium to ultimately get the desired results. But yeah, basically that year one would happen. You would we've closed these arrangements with over a dozen banks from, private banks to leveraged life specific banks. You would borrow that $1.4 million. It would go straight into the life insurance plan. You would pay $125,000 to the bank, which in that first year scenario would cover the $82,000 of interest that would be due based on a 5.75% initial lending rate. And then the rest would go into the loan principal. That lending rate is a real world scenario that high net worth individuals can ultimately get. And then we are driving that rate down to 4%, which is more or less a long-term average. When we went and we would, customize these plans for you individually, that can definitely be a discussion on where you see those rates going. And then we would also ultimately stress test the policies and show you in worse lending rate environments what it would look like, and policy underperformance as well. So you could really see, sort of the worst case scenario, and ultimately that the plan still would work out and look really attractive.
Thanks, Joel. And for those that are on the call, so if you're worth $20 million right now, we're really looking at using, 1/20 of your portfolio over the next 10 years to really create that lasting legacy. And this far right-hand column, what you're seeing there that's the net IRR from the death benefit. So going out to age 88, you can still see that is a tax-free 11% rate of return to your beneficiaries based off of using life insurance. Again, this is what we really look at as that legacy play. So wherever you're worth now, like we go put that into our calculators and we try to estimate where your net worth is going to be in the future, to most importantly, to help you offset taxes. Again, love to be able to reach with you. Please set up a meeting with us to kind of go over if this is a strategy that would work with you. You may be uninsurable. We may look at using a spouse. We have what's called a second to die policy, where we can have an uninsured spouse with an insured spouse, and these policies work very, very well with that. Typically, when you do sit down with us, your consultation email, that once you click on it, you're going to give us all the basic information. So we'd like to have our illustration in hand, at least a hypothetical illustration that fits your needs. And then we'd really start tailoring it down. We'll look at getting underwriting involved. We'll look at getting some soft pulls off your medical history to see, in this particular case, we're showing this for a preferred non-tobacco smoker where we're dealing here. So this is our finance life leverage, using it for a legacy play. Really, most importantly, especially for those that have illiquid assets, whether your money's in your business, whether your money's in real estate, this money is going to be typically within 2 weeks time period. Once a death certificate is delivered, that would be either in your estate or in your irrevocable life insurance trust, creating that liquidity event that you aren't necessarily going to have to do to sell businesses to pay the estate planning taxes. This example right here is we're looking at the same borrower, so that same 50-year-old non-smoker. We're still borrowing $1.4 million. We still did the same cash flow, so $125,000 every single year for $1.25 million. But the key factor here was they not only wanted to use a legacy, but they also wanted to have money while they're still alive. So in this particular case, what you'll see here is just kind of highlighting at year 19. At year 19, we actually borrowed from the insurance policy $16 million. So we paid off the loan to the bank. So you no longer have a collateral assignment on this. And then they start borrowing from their policy. So they're borrowing almost $475,000 a year. And we're doing that from age 70 to age 88. So we're doing that for 18 years, tax free. You don't have to report this to the IRS. You can't be sued for this asset. And in addition to that, there is still on this column here at that 88-year-old, there's still a $6 million death benefit that is going to be given to the family. Of course, you could see here that death benefit gets as high as about $24 million, and then we pay back the loan. What you're not seeing here is, and this is really where whether you use life insurance as an asset or not, is when you borrow from your policy, the account value still grows like you never took the money out. So putting it another way is you never stop the compounding interest that happens in this account. So even though the cash value, the surrender value here got up to $20 million, what you're not seeing here is the account value is still growing. In this particular case, we estimated a 6.45% rate of return based off the index strategy that we're using. What you're not seeing here is that is still growing. So 6% of 21 million is still growing every single year. So we were able to capture two different things. We were able to provide income tax-free while the person's alive. And then we're also able to provide a legacy. Now, this is on a 50-year-old. We could also look at doing the same thing for your 20 to 25, your 30-year-old children, where you're actually able to borrow from them off of their policy while you're alive, and then that death benefit just keeps growing, and that death benefit will your kids would then take over the loan payments and receive the loans, and then your grandchildren would get the overall death benefit. Again, very specific. We'd love to be able to talk with you exactly how this would work for your family situation. So we have superior lending relationships. So the key factor is we work with other financial advisors and other life insurance agents, because if they're only doing one of these policies every couple of years, there is so much detail and so much planning. There needs to be working with the bank every single year, making sure the collateral of the bank is there, having the relationships that we have with the bank. So, if you have a financial advisor that you work with that doesn't do these, we'd be more than happy to work with them to show them how this works. But more importantly, you don't want a financial advisor or a life insurance agent that never does it. That's why we partner with Selector, because that's all they do is premium finance in addition to some of the other ancillary products they offer. They are the experts, and they are going to create these, as Joel was saying, with the stress tests that are involved. So you can see obviously some of the major banks that we work with. What we're dealing right now, here's the SOFR is at 3.62%, the bank spread of 1.25. So we're all in. Our current lending rates are about 5%. So we still feel that we are showing that 5.75 is very, very accurate. The one thing you're going to see on the next slide is lending rates versus the collared S&P 500 return. So what you're seeing here is, in this column, this is the historical data from 2005 to 2024. And this is the S&P here as far as the returns. When you're looking at an indexed universal life, you have what they call cap rates. So that means the most that you can make is wherever that cap rate is at. So if the market in this case in 2005 did 3%, your cap was 12, you made a 3%. That particular spread minus our lending rate, you were down that year. Next year, you're actually up. But if we went from 2004 to now, you could see the average arbitrage was over 3% spread. That means you're making 3% off of the money that you borrowed. And this is really where the last thing I'll show here is that for why we like Index Universal Life as a strategy is in 2008, when the market was a negative 38%, it was actually minus 55 from top to bottom. But the year end was negative 38%. You didn't lose any money in your account. You start over that next particular year versus if this is your investment account, you obviously knew what your portfolios did during 2008 and real estate portfolios as well. So that's why we've really kind of looked at that long term. And this is why banks love this strategy, because they know that there's never a negative year versus if you use, for those that have used margin or use your accounts as leverage, the banks want to see that statement every single year. And they're also, it's very volatile. You may have a capital call where you have to come out of pocket. Where here, your only capital call is going to be is what you're looking at here. So this is Colin Azai's information on the phone. Feel free to reach out to both of us. I know Colin was sad he wouldn't be able to make it. We're talking last night, he couldn't get out of Newark. My phone number is 813-807-0391. But at this time, we'd love to answer any questions. For those that want to scan the QR code, please scan the QR code on the right-hand side with your phone. We'll kind of pause there. And please, if you either want to raise your hand or use the Q&A section, we'd love to be able to answer any questions for you. And again, most importantly, we want you to understand is that we're here to help you build a lasting legacy, whether it's building income now or building a legacy. And we're also trying to help you disinherit the IRS when it comes to the estate taxes. Because right now, that $30 million exemption is a lot higher than it's been in years. When I first got in the industry back in the early 2000s, it was $500,000. So we don't know where the estate tax issue will be at in the future. What we do know is we can start planning on what does that look like on the life insurance side. So feel free to reach our team at 866-971-6221. And also in the chat, you can click on the link in the chat as far as be able to schedule a phone call with us as well. So any questions, feel free to raise your hand and we can bring you off microphone. So one of the, I'll ask a question is, and Joel, you can chime in on here. One of the things that when you look at why people think there's a lot of risk with premium finance is the lending rate. So Joel, you want to talk that, and Kishore, we'll come to you right here. One moment.
Yeah, the obviously the program is obviously borrowing money, so there's a lending rate involved. And for high net worth individuals especially, they can typically get really attractive rates from their private bank or, again, these premium finance specific banks. Even in a high interest rate environment, it typically means that the life insurance carrier itself's general account also does better. So in a high interest rate environment, the life insurance world also typically increases caps, which ultimately increases that potential arbitrage spread as well. And then, as Michael showed you, these are long-term plans in nature. So that arbitrage over the 20-year period of the 3.6%, it truly does stand up. One thing is that we sort of like to stress about is you can't go into these type of programs with even 5 or 10 years in mind. These really, especially with income and those type of scenarios, you need to let that arbitrage really work to ultimately be able to pay back the bank. So these are legacy plans and long-term strategies.
Yeah, great point, Joel. And for you were mentioning on the cap. So just to like, I got in working with Index Universal Life right around 2009, 10 time frame. And that's kind of where the average cap rates were at. And you can
Yep.
see here that they did start going down. And then they are right around about 10% right now. So that does directly affect of where the borrowing was at. So you could see here, obviously, when rates went lower, so did the cap rates there. When rates go higher, the cap rates end up being a little higher as well. So yeah, thanks for that one, Joel.
Cool.
Let's see, Kishore, I'm gonna if you'd like to come off, we're gonna allow you to talk and ask the question. And yes, there will be a recording. We're gonna be sending out not only the follow-up information is, we will be sending out the recording once we get it onto YouTube later today. And then we will be sending out follow-up messages for everybody. If you don't want to receive these, we don't want to spam your inbox. So please just, either hit remove or unsubscribe. But we will be sending out similar case studies over the next 3 to 4 weeks. And again, most importantly, we'd love to be able to set up and have a time for you. Are there any other questions? Feel free to either raise your hand or type it in the Q&A section. And I notice we have a couple of financial advisors on the phone. We'd love to be able to partner. That's where, I met Colin and we realized that I need a team like he has behind him with Schlechter as far as when it comes to premium financing. So we'd love to be able to set up a call with you and see how we can partner together with you and use our team with our expertise as well. So please use the Q&A section. Joel, is there anything else you want to point out that we may have missed in the call, or any lasting thoughts?
Just the lasting thoughts would really be the flexibility of these plans. Nothing is really set in stone. There are ways to mitigate risk. There are ways to enhance the front end if collateral is of concern. There are, ultimately ways to get out of the plan and unwind it if your financial situation were to, for some reason, drastically change. But no, this is a strategy that has been put in place now for a long time, and for the right client, like Michael was explaining, sort of where that net worth is gonna get over that 30 million at this stage. It's a really powerful tool that can help leave a really long legacy.
Perfect. Thank you. And Amit, I see that you had a question here is, what are the risks? No one wants a free lunch. So here are the risks. The risks are, we're borrowing 1.4 million. You are on target for that loan repayment, meaning paying back the interest over a 10-year period. So that is obviously one risk involved. In addition to that, these are our estimated collateral projections that are needed outside of your insurance policy. That's obviously another risk of making sure that whether you have that money in a money market account, a stock account, if it was in a stock account and the investments went down in any particular year, there could be a capital call on that collateral. So you're always going to need to have that projected there. So you're absolutely right. There are no free lunches here. The banks we work with want you to have skin in the game. They want you to at least pay interest only versus, if this was a traditional whole life policy, you're on target to making that premium payment, for 20 years. There are other risks when it comes to what are the risks of the lending. We've only had one issue where one of the banks we were working with some of the customers we had to refinance and go to another bank. But banks love this as an asset class because 100% of their money is protected. Unlike real estate, if they have a collateral assignment, most banks don't want to take over a real estate project and then have to sell it. Here, if there is a default, they're getting the cash value back and they're getting the collateral assignment projected there. So the other question is, what about early death? Well, early death is actually handled. It's actually in your favor. It is life insurance. So if you were to pass away, you can see in this right-hand column, in year 3, you're actually seeing a 402% return of your money because you've only came out of pocket for $375,000, but your family's getting a $19 million death benefit tax-free. So this net death benefit is always going to be the idea that what you have. So hopefully, Amit, that answered your question as far as that. The other thing is you have to be insurable. We're showing this as a preferred non-smoker. You may not be insurable. Obviously, there's a risk of and that's why when we sit down with you, we'd like to kind of initially show you what it looks like for your family. And then we immediately get our underwriters involved because we don't want to we want to make sure that we're building this exactly. Then we'll work with Joel and his team to come up with anything else. So, Joel, did you want to answer before we go to the next question? Anything else on that?
Yeah, just that there's also ways to, mitigate some of those risks. If interest rates are higher and the cash flow, besides the 125,000, it might have to jump to 250,000 to make the plan, sort of stay on track. But again, it's a long-term plan, so it would likely be the reverse, maybe 5 years down the road where $125,000 isn't necessary and you could maybe put in a little less. You can also borrow more premiums. That's another way to sort of eliminate some of these risks depending on the environment.
Yeah, exactly. So your loan is with you and the bank, and you're absolutely right, Joel. You can come and you can actually pay more of it down. You can borrow less, come out of pocket more, and that kind of as a caveat right into what. Hopefully, I'm saying this right, Kushal, you're absolutely. We definitely can move your whole life and your SUL plans if there's cash value in there. Life insurance is a very highly regulated industry. We would only do that if it makes sense to bring that over into the new policy. So our team would actually analyze your existing policy. We'll let you know if it makes sense or it doesn't make sense. Some cases, very few, where it would not make sense to move it from where it's at unless you're now uninsurable. And anytime you ever do, and this is just a safety, if you're looking at converting to a newer policy, keep the premiums going and making sure until that gets converted, you don't want to cancel policy until you get your new policy. So we absolutely can move over that into that. And that just interjected. So what you're not seeing here is we could either borrow less that first year, or we can have it where we're building it. And one thing is when we build these life insurance policies, the IRS has limits. So for it to be life insurance, they have what's called the 7-pay rule. And we, of course, meet those guidelines. So that 7-pay rule is there's only so much premium you can put in there without having a very large enough death benefit. So all of our policies stay into what we call non-MEC policies, which is a non-modified endowment contract. That means that we're trying to keep this as a tax-free, efficient vehicle. Now, it would make sense if you only want it for the death benefit to do what they call a MEC, where you're putting more money into like a single premium policy up front. And depending on how your policies are structured, Kushal, we would look at those. Love to be able to set up a personal call to you and see, how to analyze the difference between whole life and index universal life. One of our life insurance agents we've been trying to partner with, he's in a company that only sells whole life insurance. So we are looking at, can we do these strategies with whole life, even though it could be done, the index universal life over the long term is almost always going to outperform that 4 to 5% that you're going to earn in a whole life policy. So hopefully that answers your question. We'd love to be able to, so I'll be able to set up a personal time for you. Any other questions? Feel free to raise your hand or come off mute, or you can chat in there. Joel, did you have anything you want to add to that?
Yeah, just on the whole life and SUL policies, especially if they have cash value, it's called a 1035 exchange. and they can be put straight into another policy. The other commonly used, like Michael referenced, is those policies could be in really great shape and have a really good standing. What they can also be used for, though, is to cover any type of collateral. So they can ultimately be tied to the plan and ultimately facilitating and helping the plan, but ultimately they don't need to be moved or anything like that. You would just set up a new policy, new premium, and these would sort of be an additional backstop that the banks would ultimately really like, and it would keep that column 12 to a minimum.
Yeah, and that's a great point, Colin. So, Kishal, we could actually wait just to reemphasize that this is your collateral projection. If your whole life policy has at least that in there, and you don't want to put extra collateral to the side, it may make better sense to have that separate and just use that as a collateral assignment. Banks love
Right.
that, using that. I mean, I have clients that just use their life insurance cash value for personal loans, just because banks love the ability is they know they're going to get paid off the death benefit. So. How is this better than borrowing from my own whole life policy? That's a great question. So, really, what we're doing here is when you're looking at borrowing from your own policy, you're doing two different things. You're borrowing from your own whole life policy. You're using that money while you're alive. I personally do that in my wife and I. I have a whole life policy. She has an index universal life policy. Two different reasons to have them, but you're always able to use that as leverage. So now the difference is, I think to answer your question, Zenaria, is the whole life policy is your course going back to this strategy is, you're required to keep making those premium payments. In our index universal life, the way we build it is we're only borrowing the interest only, where you're allowing the bank to pay the difference. So that's really where you're looking at that arbitrage of what you can earn inside the policy versus what your borrowing rates are. So we have clients that actually can borrow from their whole life policy. You just put it on your, are you, one of the questions in the life insurance is, are you financing this policy? Of course, we are financing it. You can finance it with your own whole life policy. So absolutely you can do that. I love using life insurance for loans. I personally do that with my investments as well, as I'll borrow from my life insurance policy, put it into an asset that's going to be either tax advantaged, and then I pay myself back as well. So we definitely could do that. Joe, do you want to answer a little bit more? Is like, how is this better than borrowing from your whole life? Anything else I missed there?
Um, I guess I'd need to dig into what the current whole life policy actually looks like, but typically with IULs also there are different ways and stuff to borrow from the policy itself. Index loans where you're still getting the market on you're getting the market participation on the loaned money. That can be one advantage. Also, just the growth inside of the IULs is much stronger typically than a whole life. So just the sheer amount that you would be able to access would be drastically different.
And that's a great point. So just going to what to emphasize what Joel was mentioning in 2000, if you're looking at the slide in 2012, the S&P cap was 13%. So your earning inside your index universal life was 13%. If this is a whole life policy, of course, you're borrowing it from your whole life. You're typically paying that 5% back. In this particular case, we're looking at when we borrowed it, the rates were down at 1.8%. So we actually earned a spread of 11%. In this particular case is that individual had their money earning in two different places. So they took the money out of the policy. It's earning somewhere, whether it was in a money market account, used for purchase of real estate. So Zunaria, that's probably what you're doing when you're borrowing from your whole life. The big difference is that extra arbitrage spread. And that's really where we're looking at here is why we choose the collared S&P 500 index versus whole life is when you borrow the money, that your money still grows like you never took the money out of the account. So that's really where the big difference is. And of course, we're using bank money to be able to fund these policies. Just like when you buy real estate, if you can put 0% down, if you're a veteran, put 0% down. or if you're putting 30% down because it's an investment property, that's your skin in the game where you're leveraging the rest of that. And then, of course, you're borrowing your money there. Any more questions? For those that are watching, please give us a call at 866-971-6221 to be able to talk to our team. We'd love to see how this works for you and your family on an individual basis. Once we start getting into the numbers, that's when it'll really make sense. And you'll be setting up a meeting with both Noel McCall and I are on those calls, and then we bring in Joel to help with our illustration software as well. Are there any other questions? You can either raise your hand, use the Q&A section, or type it in the chat. Colin, any lasting thoughts? Looks like we don't have any more questions.
No, this was great.
I'm sorry,
Thanks for
Joel.
having me.
We do. I'm sorry. So Jenny, give me one moment. So Jenny, we'll allow you to go ahead and come off and talk if you want to unmute.
Yes, can you hear me?
Yes. Hi, Jenny. How you doing?
Hey, very good. Yeah.
Good.
Okay. My question is, how do I know if someone borrow money from the life insurance?
I'm sorry. How do you know? I'm sorry. Can you go one more time? How do you know
How do I know if someone borrow money from the life insurance?
someone borrowed money from your
Because you
life
said
insurance?
that for the income tax, it doesn't show and stuff like that.
Correct. Yeah. So with life insurance, there is a IRS tax code with life insurance where when you borrow money from the insurance policy, it's not
Uh,
reportable to the IRS. It's not
oh,
also reportable if you have children going to college on the FAFSA.
mm,
Life insurance is a protected asset, just like a retirement account would be. So that's the interesting part is you never have to report that tax-free growth to the IRS when it comes to there's no reporting necessary. So did I answer your question, Jenny?
yeah.
Okay, great. Thank you. Any other questions?
Looks like we have one more in the chat.
You want to read that, Colin, for the group?
I have all of my whole life
I'm sorry, I keep saying Colin,
SUL.
Joel, excuse
You're
me.
fine. Policies paid off, but I won't want to put any more money in to get a new IUL product. So there would use cash value from my existing policies to fund new IUL without putting in additional new money, a new policy. Overall, yes, absolutely. It would be similar to the conversation that Michael mentioned of 1035 exchanges. You would ultimately tax free liquidate the cash value in your current policies, and we would put that into a new IUL policy either over the next year or a couple of years, depending on what you currently have. And honestly, I do this pretty much daily. I assess if that makes sense, and we would ultimately show you side by side of your current policies, how they're projected to perform, and then what would happen if we 1035 the cash value and bought new policies in a different structure, an IUL, which could ultimately then be financed. So you could borrow additional premiums on top of that. And because you've had your 1035 exchange, you still have skin in the game. It would help with the collateral conversation, and you would have to put no further dollars from your own pocket into the plan. So that's a prime example of we would have to see what you currently have. We would sort of do some back end analysis, and we would show you exactly side by side under similar assumptions what we think it would look like.
Yeah, and to reiterate what Joel has mentioned, if you want to just even give us some basic numbers, let us know your age, if you're insurable, I know you obviously these policies are paid up, but when was the last time you were at the doctor's? If as long as there's no major health issues, let us know that. Let us know how much cash value you have available. I mean, ultimately, we'd love to see the actual in-force illustration and statements, but if you let us know kind of where you're at, then that would be help out with our initial planning when we actually do have our first meeting to kind of see what does that look like. You could potentially, just to reiterate, whether you 1035 the money into it or you're using the policy loan provisions, if it makes sense within your policy, to borrow from your policy to be paying your the interest off of the new policy. So there's a lot of different ways to do that. I'd love to be able to sit down with you personally with Colin and I to really do a deeper dive to see what makes sense. Because again, we're extremely regulated industry. We would not tell you to do anything that doesn't make the most sense for you, especially when it comes to 1035 exchanges. It's very, very crucial that we are going to work with our team to make sure it makes the most sense. And if it doesn't, then we can look at you either using that as a collateral assignment, borrowing from the policy. There's a lot of different ways to be able to build that. So hopefully that answered your question there. I'm going to text you my email address is going to be in here as well. If you want to just email us your situation, or feel free to go ahead and just set up a meeting with us as well. We'd love to be able to just sit down with you and really do a deeper dive, do the scrub that our team does as well behind the scenes. And also, we look at your full network, because even though you have those insurance policies, you may want to look at doing an irrevocable life insurance trust to be the beneficiary and be the owners of those. So really depends on where you're at and what you're trying to do legacy wise, what you're trying to do for tax planning wise. And we have the in-house attorneys that can help you do that when it comes to that structuring. And if we need to have them on our calls, they're readily available as well. Great questions, though, really. Are there any other questions? Feel free to raise your hand or come off mute. We'll stay on here for a little bit longer, but we really appreciate you spending your lunch hour with us today. If you're on the West Coast, your breakfast with us as well. But we'd love to be able to kind of sit down and do a review. Please scan the QR code to be able to meet with Colin and I when it comes to that. But any other lasting questions? I think we're good. Well, we really appreciate everyone's time. I hope you have a blessed rest of your day. Enjoy your weekend. Most likely on Monday to Tuesday, you'll start getting emails from us. Again, we don't want to spam your inbox. So if you're not interested, just hit unsubscribe. But we will be offering the same webinar again on September 14th. So if you have anyone else you'd love to be able to share this with, we'll also include that in the emails that are going to be going out as well. The recording will be going out most likely on Monday as well, once we finish that. So thanks, Joel. Hey, thank you so much for filling in for Colin today. Really, really appreciate it. Since there's no other questions, God bless you, everyone, and have a blessed rest of your weekend. Any last thing else, Joel?
No, thanks to everyone, and have a great weekend.
All right. Thanks again. Take care.